So we'll get going here. We've had a lot of discussions today talking about the endowment space, talking about universities. I think we're going to switch gears a little bit and talk about endowments and universities, but more so the other side of the coin. We're thinking about the broad 403B market. We're talking about over $1 trillion in assets that are kind of up for grabs. And when we think about universities, it's not just the endowment, but also the defined contribution, the retirement side of the organizations, right? And so with that, we have a panel here that's going to give different perspectives on ESG and defined contribution and give a little flavor of the university perspective. So kind of taking a step back where we are when thinking about the retirement space in the U.S., it's all around regulation right now. The proposed rules, which I think everybody in this room, if you have any skin in the game in the retirement space, is really focusing on that right now, right? Because we've been waiting for the DOL's proposed rules to actually come into act, and so we're waiting on that as an industry. So when we talk about that today, it's around a couple of things, right? One, ESG becoming actually permissible within the retirement plan. When we think about that, the economics need to be there in terms of considering financial materiality as part of considering sustainability and part of that plan lineup. But as we know, sustainability, not all things are created equal, right? There could be different approaches and objectives that are considered. And so when it comes to these DOL proposed rules, there are other things to consider. And that's to say, sure, we can consider the material factors that can be part of the strategy that's considered integrated, but what if there are objectives and outcomes in mind? And what does that mean for the considerations of the plan sponsor that's leading the retirement program? And so when we talk about this today, we're going to try to get some different perspectives from the consultant side. We have two asset managers here on the panel, as well as a university. And so with that, I'm going to start and turn it over to you, Roberta. So, there's a lot of change in this interesting time in the evolution of sustainable investing right now. When we think about this from the perspective of, the universities and the different defined contribution programs, there's different approaches to sustainability that can be taken. There's different considerations that are going on right now in terms of returns as it relates to allocate to sustainable investment strategies. How are you thinking about this from the asset management side of things? What is the market like? What does the risk returns look like for people allocate to sustainable investments? And what's the market outlook for retirement from DB's perspective?
Yeah, awesome. Thank you so much for that fantastic question, Laz. And also a very relevant question. First off, I just want to say thank you to all the IEN folks for organizing such an informative event. And also thank you to everyone for attending. In the past few years, it's been amazing to see the growth in ESG-focused events and even things like Climate Week itself. And we think that some of the growth in the space is due to demand in the market, sort of getting to your question, Laz. Our clients are really demanding ESG investment options. So your employees at universities or hospitals are telling us these issues matter to them, and they matter for who they choose to work with. So in that vein, with the rise in consciousness about equity, diversity, and inclusion, we're seeing that this is something that investors care about. To bring this to life a little bit, Newton's 6th annual Responsible Investing Survey actually found that 69% of employees would feel good about their employers if they had ESG investment options available on their plan menu. And even further than that, 65% would be more loyal to an employer if they had ESG investment options available. So, I think some of this demand is also reflected in all parts of the market, across industries, across asset classes. We've seen globally, sustainable funds, assets under management has skyrocketed to almost 2.7 trillion, that's trillion with a T. And within the United States itself, the number of sustainable funds has grown exponentially, from about 100 in 2012 to over 500 different investment options currently. So we believe that what's driving this demand and driving this growth is really performance, which also gets a little bit to your question. We found that, and of course, you can slice and dice numbers and time frames in any different way you like to show whatever you want, but it's really getting hard to ignore that ESG investments outperform. So companies that have credible and actionable plans for addressing things like climate change, addressing gender equality, addressing board diversity and transparency, these companies outperform their peers who may not do as much rigorous planning with regards to ESG factors in the changing world. So, with all this taken into account, we really encourage you to take a look at your retirement plan menus. Are there enough ESG investment options that your employees want and are asking for? And we'd also invite you to talk with your record keeper, who can help educate some of your participants on the available investment options. And happy to talk to everyone. Hope to see you guys at the reception afterwards. And I'll pass it back to Laz with that.
Thanks, Roberta. I mean, part of what I'm trying to get at today in these kind of sessions are how these different pieces of the market can work together. It's not just one group or one actor trying to get these pieces of the puzzles together, but I think we all need to work collaboratively. And we'll get to that, but now we want to go to the consultant's perspective. I think, Max, you're in a really interesting position in terms of kind of catering to different sides of the markets, working with asset managers, but also working with the allocators, right? Today we learned about different perspectives from the university side where you can have missions within the endowment actually leading to action that is for alignment, right? How do we think about, in your perspective, the different values that are going on across the market? You're dealing with people in different regions, different demographics that want different things. How do you consider that in your practice going forward?
Absolutely, it's a great question, Laz. It's great to be here. For those of you who may not be familiar with what consultants do, because I don't want to presume a level of knowledge, but we work with institutions, including endowments and foundations, retirement plans, including 403Bs, which are for not-for-profit, DC or defined contribution retirement plans, which is what we're talking about here today. So, what we typically do is we work with the investment committees who oversee the investment options that are placed in the plan. Think about, who's investing in what, are there adequate contributions, who's withdrawing funds or taking loans, and it's kind of managing all of these different elements of what makes up a plan. And so our role is really to help, typically, in helping the manager selection. So selecting those particular funds and the investment manager ultimately who runs the different investment strategies that get placed in that lineup. So we advise the asset owner or the investment committee in this, staff, and really try to help them figure out what makes a strong plan that allows a participant to diversify their investments in the way that they'd like to. That helps them develop a secure retirement over time. Now, when it comes to questions such as ESG considerations, there's a lot of different pieces that go into what a good option or not as good option might be. Because it's a defined contribution and participant-directed plan where each participant selects what they'd like to invest in, of course, there's this level of, you can provide a lot of information, you can provide options to your participants, but you don't actually know what they're going to do with their money at the end of the day. And their views of what might be something more values aligned for them, I don't want to be in fossil fuels, or I don't want to invest in tobacco, or I do want to invest in renewable energy, or what have you. That gets very tricky because you have maybe thousands, not tens of thousands of participants that you're trying to select investment options for. So what we try to do is help our clients to think about who are their stakeholders, who are the members of their plans, what are their families, what are they thinking about, and out of all the different inquiries that might come into your human resources, or however those inquiries get filtered up, saying I'd like a Sharia compliant fund option, or I would like something that is fossil fuel free. How do you kind of negotiate amongst these different perspectives amongst your participant community to find if you're going to offer one option or maybe multiple on your plan that are more kind of sustainably oriented, or again, maybe Sharia or other ethically motivated. How can you do that in a way that fits with your fiduciary duty, which is your responsibility to your members? So all this to say, it's tricky. It's not an easy thing. However, there are ways to do this. And so what we typically will do is issue surveys to the members, the fiduciaries of that investment committee to understand their individual perspectives of what they believe to be material risks and opportunities, and then also to think about their participants' views. What have they heard, knowing their community, knowing the university or healthcare community that they operate in, what are their particular perspectives? And therefore, what sort of options could they then offer that would meet those needs? In addition to all of that, of course, though, we certainly want to consider issues of equity and diversity questions as well. And so what we can also do is look through working with record keepers to see the racial, ethnic, age, kind of sex, different questions, gender questions of the participants in the plan and see who's, broadly, not looking at an individual person, but more if you aggregate people into kind of profiles of different participants, kind of amongst the number of folks. What are they doing with their money? Are they withdrawing more than others? Are they taking loans out more? Are they not saving as much as they could be? And that's another question of helping your participants to have a safe, secure retirement that they can save for over the decades that they're probably working for the institution. But to do so in a way that you can target some revenues to, if you're seeing some potential issues on the horizon, or demographic groups not saving enough or not able to save enough. I mean, it really can inform how you want to think about these issues in a way that goes beyond just the investment lineup to, again, how are your participants actually engaging with the retirement plan? So, a few different answers to throw in there. Thanks.
No, that's really helpful, and I think what's most interesting is that it's evolving, right? This has been seen as a values exercise and has grown into a risk exercise, and we talked about earlier the Inflation Reduction Act. This is also turning to an opportunities type of exercise, right? We are seeing the pendulum swing in the right direction where things become more economical on the energy transition, for example. Switching gears to the university perspective, David, from that side of the coin, can you talk a bit about sustainable investment adoption in practice from your side of things, and how is Chatham University setting itself up for success, and what can other peers of yours be doing to kind of follow suit?
Thanks so much, Lance. And, I think it's a really interesting moment because of the changes that are happening from the Department of Labor and just where we are. Chatham, and we're a part of an organization that works closely with IEN called Second Nature, which is all of the colleges and universities around the country that have made a commitment to go to net zero. And so if you look at the history of these two organizations working together, a lot of the focus has been on universities' direct emission, climate emissions, greenhouse gases, and how do you reduce that? And it's been around endowments, and how do we use those as a tool to accelerate the transition to a clean future. And I think where things are evolving now is to say that those have both made important strides, but like the rest of the economy, it's not enough, and it's not happening quickly enough, and so we need to look for ways to accelerate it. And so, to me, where we are now with retirement plans is exactly where Roberta said, which is universities and colleges are no different from any other employers in our sector. We're in a war for talent right now, and it's tough, right? And so being able to say to your employees, we allow you to align what you're doing for your retirement savings with your values and what's important to you. That's one of the strategies when you think about your overall people strategy to build loyalty. And when that happens to align closely with what the university's mission is and what it's about, I think that does it further. But we're trying to think about also how do we work with all of our partners in different parts of the community to accelerate that further. So how do we work with our local employers, our nonprofits and others to move this? So I think this is a great opportunity, and if you look in your booklets, we have actually here a pledge which we're launching today at this event, which is a number of different types of universities, some of the largest publics in the country like Arizona State, small privates like Chatham and Lewis and Clark that are saying to our peers, we're not saying you need to move all of your employees' retirement plans into sustainable investing. That's not our role. But we ask you to look at it hard with the changes that are coming. Look at what you now offer, and are you offering choices that would allow your employees to align in this way? And so we think that that's a really nice opportunity. And just to give you some size of scale, so Chatham, even though we've been around more than 150 years, we don't have some of the big endowments you read about in the paper, so we're just over $100 million. You have another $50 million that's Chatham has been the primary funder of, that's in our employees' retirement savings. Well, if we could leverage that and you had a similar percentage across the country, that really multiplies the impact that you could be doing.
So a lot of moving pieces for all of us respectively, right? I think there's components of this early on where an organization is kind of looking inwardly and saying, okay, what are our missions? Are we trying to make any missions, and should our investments be aligned with what that mission is? And with that, you might be surveying your participants to understand where theirs might be aligning as well. As you kind of go down that path, it turns into how do we actually deploy this in practice? Are we looking for something that's all-encompassing and focusing on risk-adjusted returns, or are there objectives that we need to consider? And with that, I think there are components of this regulation that's going to be really important and could be more important for all of us to be able to work together. And the FCC's proposals are really not that much different in terms of you really being able to prove that you are doing what you're saying you're trying to do in achieving an objective and measuring that objective over time. I think that's going to be the most important thing to really wrap this around in a way that has some longevity to it. So with that in mind, my self-serving question is, how can we, consultants, asset managers, allocators, work together to just go down a path that we can all stand behind and is right for the industry? Starting with you, Max.
Sure. Well, I think engaging forums such as this one, of course, is really helpful. I think a lot of this comes down to education, and it's educating the fiduciaries of the plan, again, those investment committee members, helping them understand what are these issues, how could it apply for their plan, and to do so in a way that, again, supports fiduciary decision-making on behalf of others. But I think that the other key piece, though, is really once you make any changes, or you're considering making changes, really educating your participants. Working at, I think you mentioned this, Roberto, is an essential piece of working with a record keeper, whoever manages the kind of plan on the back end, to ideally issue some sort of participant communications out to them about what are the changes that are happening, why are these funds slightly different, than what they've seen in the lineup previously. And that's a tricky piece I think is often not adequately covered when plan sponsors do make changes in the plan. So you can get under investment basically. If a new ESG-oriented option gets added to the lineup, typically it doesn't see the sort of new money that you would expect necessarily. And I think I frankly haven't talked to a lot of plan sponsors because simply participants aren't being told why this particular fund is different than the others. And again, not that you need to privilege it over others, you have to be careful there, but you just want to at least share some background about what it is. So, long-winded answer.
Yeah, Max, I want to absolutely echo events like this are so necessary, I think, because it allows for the communication that's really necessary. It really is a team effort, it's a we thing, and beyond that, there's so many things to think about, but it really does come down to performance, risk, and assessing things like that. But of course, with the increased urgency in climate change, the increased scrutiny on things like racial equity and social issues, it's just becoming an issue that we need to pay attention to today.
I would just say, another reason why I think both the retirement plans and university endowments are good vehicles for this is by their very nature, they're both long-term in their outlook as opposed to other people who look at investment with day trading and trying to make quick returns. And so if we can collectively, all of the actors in the system, build up the data that you referenced, Roberta, where you showed there isn't a trade-off. Actually, if what you're really concerned about is long-term returns, that getting the most responsible corporate actors that are actually looking at their holistic approach to their stakeholders and managing it effectively produces good, reliable, reduces risk. That's a win for everyone, and it gives you the evidence you need to take on the critics who say, all we should care about is, what did you do for me this quarter?
Thanks, everybody. So we're going to move to questions from anybody in the audience, if there are any.
In terms of new money moving into funds, I think that there's an institutional inertia when you add a new fund. Us as fiduciaries to a direct contribution plan, we can't invest in anything with less than a 10-year track record. So I'm curious what the thinking is in adapting to existing funds, and in particular, it's hard to hit reset once you get somebody activated in a plan. So what are you doing with things like target date funds that would have an ESG lens or an option that might be a real area to move the needle faster than what complying to ERISA allows us to do currently?
Sure, so great questions. Well, I think the 10-year track record, that's long. That's very long. So there's been a lot of development in the kind of sustainable investment space in the last 10 years, obviously. So anyway, hey, if it's written into your investment policy or whatever, that's I would just suggest maybe just taking a look at that, because that really reduces your universe of potential options. So sorry, not investment advice, just observation. Yes, I think it's a great question. I think so. The target date fund space. This is an area that I think when this Department of Labor rule finally, well, gets finalized, I should say, hopefully we'll start to move the needle a bit on opening up more options. Because basically there's two available target date funds, and for those of you who don't know, target date funds are multi-asset strategies that are essentially, if you typically, it's called a default oftentimes. If you don't select an investment option in your plan actively as a retirement participant, you just get put into that fund. And so a lot of people just kind of leave their money in there. They maybe continue to accrue it, but so that it's a safe harbor option for the retirement plan sponsor to offer, where basically most assets, typically 50 to 70% of the plan's assets, tend to be just located in that target date fund because they're designed to help kind of shift the risk and conservativeness of the fund exposures as you get closer to retirement. So it gets more conservative as you get closer to retirement. Anyway, sorry, digression, but just wanted to explain that because it's a really good point. That's where the bulk of the assets tend to be in the average plan. If you can offer an ESG-oriented target date fund, that could shift some assets. Now, there's implementation considerations around that. I probably shouldn't get into it, but is it going to, this new deal regulation, allow for an ESG-oriented target date fund to potentially be the default option, which is the key hurdle? Possibly. We'll see what comes out of that. So, yeah.
Do you think people are more likely to go the target date route or to have individual options to start out, right? Because people are still looking to start in ESG. Individual.
Yeah, I also just want to briefly add to that. That would be the dream, right? A default ESG life cycle fund. But until we actually get there, and this is again non-investment advice, but there are funds out there like TIA Craft Social Choice Account that have been around for more than 10 years. Non-investment advice, but just saying, I totally agree with Max. Like that is a pretty high hurdle. But in addition to that, I think what we've seen is the people who care about ESG investing really care about it. And so when a new plan is adopted, those are the people who immediately are going to start changing their flows. But to get folks beyond that, I think webinars do a really good job, and just meeting with folks, whether it's weekly or monthly, depending on how many new people you get hiring at every cycle, I think that's one of the ways that you can sort of increase the adoption and sort of shift flows into the ESG space. But thank you for the question.
So, Etho Capital, we do broad-based index creation and ETFs with a deep climate screen and full ESG and JEDI. And not investment advice. Past performance can't guarantee future results, but generally performance looking really good versus S&P 500 for now about 7 years of track record. But we're an ETF, so we are in almost zero retirement plans, even with this close to 7-year track record of not investment advice looking really good relative to S&P 500. So should we just give up? What is the current momentum towards having ETFs more accessible in retirement plans, or should we just give up on that and start licensing indexes for mutual funds to get into this world?
That's a great question. I'll just say there's a bias towards mutual funds. That's just kind of a known quantity, and I'm sure that I could probably dig up a more concrete answer as to exactly why. But I know it ends up going back to it's just when at inception how you value things, and it's just a tricky piece of the way that ETFs are constructed. I think that makes it a little difficult for DC plans to adopt them en masse, but is that going to change? It could certainly change. It could change.
Hey, Max, you had mentioned over here, you had mentioned surveying the investment committee. I wondered if you have had any experience or recommend to survey the plan participants to understand where they stand and what they're looking for in ESG investments. And if you have, what do you do with that data?
That's a great question. I think Roberta raised a great point, which is webinars also kind of, public-facing engagements could be another way of just disseminating this information. And surveying participants can be, I can imagine that if you're getting hundreds or thousands of different data points, it can be difficult to cull through. Obviously, there's many organizations out there that do that all the time and can probably help you with that, and potentially if you're at a university, you might have, folks who kind of do surveys as part of an institution or something like that. So anyway, so just a thought that I think that what would you do with that data? I think you'd get a lot of interesting data points to work with. And I think that you really have to have it be pretty clear and short survey, and leave comment boxes in, I suppose, but you might get a lot of interesting comments that go all over the map. It might be hard to discern. And so ultimately, I mean, the challenge with being a DC plan sponsor, from what I've witnessed, is that you have to cull all these different data points, participant preferences, into something that reflects very broadly the available investment options that you could select from your record if you put on your plan. And so it ends up being kind of you have to make compromises along the way, always, because again, if you're talking thousands of plan participants, you're never going to have that one option that meets everybody's needs, or even multiple options. So I don't know if that's a very satisfying answer. It's just, I think it's a really excellent exercise to do, though. And I remember one thing I heard from a pension plan sponsor out of Europe, really leading corporate plan, was that they would have these workshops with participants, kind of groups, in different regions around the world where they had retirement plans, and try to discern their input that way. So more of a discussion-based setting. You can educate them along the way, really get more robust feedback, perhaps. That being said, it may not be feasible and takes time. So there's trade-offs to both, I suppose. But
All right, we're going to try and squeeze in one last really quick question and hopefully a quick response.
And I asked Max this question the other day, but I'd love to get the perspective of everyone else. How about just making things like carbon footprint or the ESG profile of funds just much more ubiquitous, so that participants can see that and make a decision based on those factors, as opposed to risk of return, which is backward looking and doesn't really tell you much.
Yeah, that's a fantastic question. That's one of the things that we internally are working on. I totally agree. The more information available to folks to be able to make an informed decision tends to be the better. Of course, you don't want to overwhelm them with information, but something as simple as what are your carbon emissions, or even an A through F score on how you are progressing towards things like a net zero commitment. Absolutely think those would help folks in making their investment decisions. And so, we at Nuveen and me myself, I'm just a huge supporter of it, and I think we are moving in that direction. I think that's where we're seeing Europe is heading. So we may not be on the forefront of it, but I think that's definitely where the market's heading. So great. Thanks for the question.
I think that's the most important aspect of how asset managers can ultimately add value to the trickle-down effect of plan participants being educated, right? Again, like I said before, being able to demonstrate that you are having measurable outcomes in mind and able to track that on an ongoing basis for them to be able to be engaged and know what's happening and know that they're putting their money for something of worth, right? So I think that's going to be the name of the game and what a lot of the U.S. regulation is going for, really putting it on the asset manager to demonstrate this. Where I think in Europe it's more so fit into this bucket, right? And so it's going to be interesting to see the different approaches that are taken to actually educate and bring a lot of those metrics to life. But I think that's the time that we have on this panel. Thanks everybody for listening in. And I think this is a good discussion because it affects a lot of people in this room professionally, but we all have our own retirement plans too, right? And so maybe we'll start seeing some sustainability options for ourselves personally.